Good morning, good afternoon, good evening. You are watching the Paris Fintech Forum Communities video interview series. I'm Elliott Gotkine, and today I'm joined by the founder and managing partner of Royal Park Partners, Aman Behzad. Great to have you with us.
Thank you for having me, Elliot.
Okay, so before we get cracking, let's learn a little bit more about Royal Park Partners. So, Aman, tell us more. Tell us more about what you do and how you do it.
Sure. So we are a now coming up to 6 years old corporate finance advisory firm. We advise financial technology companies on capital raising and M&A activity. So that's both buy side work and sell side work. I like to think of us as sort of life cycle advisors. So we'll work with companies from as early as them doing their Series B fundraise through their Series C, D, and then ultimately trade sale and or IPO that we'll be supporting with. We have advised now 63 transactions since inception. So we are the most active fintech advisor globally. We've done deals as far east as Indonesia and as far west as Chile. But I would say Europe, Middle East, Africa, and North America are probably our core markets and where we've done the majority of our work. Just under 20 people now, split between two offices, London and New York.
Okay, so I think you've kind of answered a bit of my next question, which was about your kind of size and scope of the business. Can you give us a sense of the kind of growth that you've been experiencing and that you hope to be seeing over the coming years?
Sure. So we've had very strong growth since inception, as I said, 6 years ago. The nature and the shape of the deals that we've worked on has evolved quite in a quite pronounced way. Part of that is the maturity of our own firm in terms of the scale at which we operate at now and the size and the nature of the transactions that we undertake. But part of that is also market driven. I would say the first 6 years of the firm from 2019 through to 2022 was really characterized by a lot of capital raising mandates. Venture capital money was pouring into the financial technology asset class, and we were one of the big facilitators helping that money find really high quality financial technology businesses to invest into. I would say the last 3 years has been more characterized by a much more even split between capital raising and sell side M&A activity, where a number of those businesses that we have worked with traditionally are now considering both raising money from the market and going harder, or indeed having a surreptitious look into the market to see if there are buyers for their businesses, given what those companies have achieved to date.
And it's been an interesting 2025 so far. Of course, in the immediate aftermath of President Trump's so-called Liberation Day tariffs, there were a number of IPOs put on ice, including fintech IPOs such as for Klarna and eToro. How do you expect the uncertainty out there to impact your business, or is this just a case of wait and see and riding things out until the dust settles?
The thing is, there are so many second, third, and fourth degree implications of what has happened in the market that it's very hard to draw a straight line and say, well, this is what's going to come next, and this is the impact of what's going to happen. We can certainly look at the IPOs being paused as a very negative sign when it comes to being able to facilitate longer term liquidity for private equity funds that are deep into these businesses and venture capital funds that have been into their investments 10 to 15 plus years. And when you look at the businesses that have put their IPOs on ice, you mentioned Klarna, you mentioned eToro. There's obviously Chime, Circle. The list of fintech businesses that were either already filing or were looking to file in the next 6 months is actually an incredibly long list. And their investor bases are quite different and quite mixed. And so there are some funds there, notably the large global private equity funds, for whom getting these IPOs away is I think to say existential is a little bit extreme, but really much needed relief in terms of long-term liquidity for very large assets that they hold. For the fintech businesses who put their IPOs on ice that have a much more venture capital type shareholding base, for those VC funds to hold on for an incremental year, 2 years, 3 years, I think it's less of a challenge, less of a problem, because they are by their nature much more long-term focused. Your average hold period for a venture capital fund for a business would be at least 7 to 10 years, whereas on the private equity side, you're more looking to exit between 3 to 5 years. So that's just some of the dynamics when it comes to facilitating liquidity. Obviously, facilitating liquidity means that you get to return and recycle money to investors who get to put money back into more upcoming, younger, earlier stage businesses, and you sort of cycle through that seed, growth, buyout, IPO life cycle over and over again, and you get to increase the velocity that comes from there. In terms of what I think it's going to mean in the shorter term, let's say that over the next 12 months, the next 24 months, I think it's fair to say there's going to be some recalibration on some of the larger buyout type transactions that are happening. So deals that are $1 billion plus, take privates, etc. Those businesses that are being taken private now, I think there's a reassessment about thinking, well, what is if we're looking to IPO this business in 3 to 4 years, what are the realistic multiples we can achieve for that business? And if they're, if they're no longer trading at, if public comps are no longer trading at 20 times PE multiple or 25 times PE, and instead they're trading at 15, well, that's going to be something that goes straight to price in the short term. I don't think it changes the narrative around short-term deal making for deals that are sub $1 billion, though. And I don't think it changes the narrative around capital deployment in fintech.
Okay. So look, we'll come back to that a little bit later on, because of course we've now heard a little about Royal Park Partners, but we now are going to learn a little bit more about Aman. So, Aman, you founded Royal Park Partners in 2019, I think it was. So you're still a pretty young firm. What's been, your biggest success and perhaps your biggest faux pas?
My biggest faux pas, obviously, a lot of what we do is on the private side. So, so we're obviously bound by certain levels of confidentiality. But there have been transactions that we've missed out on, whereby I think it was clear that we needed to calibrate our risk of taking on deals in a keener way. We often see businesses that we have to make a judgment call on. Are these really interesting businesses? Do we think that there is a buyer or an investor out there for these kinds of businesses? And there have been businesses, sale mandates that potentially we've passed out on, that we passed on, where we would have led to phenomenal outcomes for those businesses. We just couldn't quite get the conviction, whether it was in the digital asset space or potentially in the raw crypto trading space, where we were unable to get the confidence that we needed, that we would be able to get an outsized outcome for those owners. So I think the faux pas would be perhaps the deals that we passed up on because we didn't feel as though we could necessarily get them a great outcome, and they ultimately did get a great outcome.
Okay. And I suppose, obviously you have a life outside of Royal Park Partners, although I'd imagine it occupies a very large part of it. I understand that when you're not doing deals and advising fintechs and traveling for work, you're drumming, hopefully not too much in the office, and kind of engaging in combat sports, again, hopefully not with your clients.
Yeah. So the drumming is an interesting one. I don't, or at least I didn't think I had a musical bone in my body, having been told by teachers throughout my my formative years that I really had no rhythm and had no coordination in my fingers, which I have to say the style of teaching has dramatically evolved over the decades. But actually, my son was the big spur. I have 4 children, and I like to have an activity that I do with each one. My son was very keen to pick up drums, and he started drumming at the age of 4. And instead of sort of after about a year of taking him to drums lessons and just sitting there in silence, I thought I'd give it a go as well at the same time. So have been drumming now for several years, and have actually got pretty okay at it. I like to. We have sort of a little garage band that we play in to while away a few hours on the weekend whenever we get the opportunity. So we'd be playing for friends and family and friends and family only. And then on the combat sports side, again, something that was really triggered by, I guess that we go through these periods where we suddenly think, oh, geez, I feel like I'm getting old very quickly. And so to recapture moments of youth, try and throw yourselves into things that maybe you wouldn't have done when you were younger and maybe a bit more sensible. So I took up Muay Thai around about 10 years ago now, and had a number of amateur fights over the years. But it's really, again, it's a case of giving myself something to work towards to keep myself fit and healthy, and to make sure my coordination is sharp, and that's really it.
Well, I can only relate to that. I do boxing with my son, although I must confess I never hit him, at least not yet. So, okay, look, Aman, a key part of this interview is to get your take on the future of finance. But first, we're going to take a very quick break, after which we're going to continue our conversation with Royal Park Partners founder and managing partner, Aman Behzad. Welcome back, and don't forget, if you're not already a full member of our community, everything you need to join can be found at www.parisfintechforum.com. Okay, and now, Aman, let's talk about the future of finance. So I know we've kind of touched on this already a little, but I want to talk about the tariffs from President Trump just to begin with. Things, of course, can change by the time this interview goes out, as we've seen them kind of change on an almost daily basis. But we've seen massive volatility on the stock market. We've seen IPOs put on ice, as we discussed. I mean, maybe just touch upon again your expectation of how things are going to impact fintechs. I mean, you talked about, for example, some of those IPOs that have been put on ice. Those investors aren't going to get that money back to then plow into, younger, perhaps faster growing and smaller fintechs. Does that mean we're maybe in for another kind of fintech winter?
I'm hoping it that's not the case. I think I do believe that the nature and the shape of transactions that are going to happen over the next 3 to 5 years are going to be different to what we all anticipated once we'd identified that President Trump was going to. But once Trump won the election, I think Q4 last year was really characterized by this sense of euphoria. Low regulation is going to be the name of the game. There's going to be an abundance of capital, American exceptionalism, Western dominance of capital markets. And actually a lot of Western leaders in countries outside of the US also increasingly parroting Trump's words on deregulation, more sovereignty for an individual to be able to make more financial decisions for themselves. I think there was this enormous sense that we're going to be going into a golden age of, again, large cap financial technology buyouts, huge walls of capital going into the fintech asset class. That was the general sentiment. Obviously, we've seen the latest developments around tariffs. As you said, this is going out. By the time this goes out, things may have dramatically changed. But where we stand today, there are some underlying fundamentals that exist in the investing market, in the private equity and venture capital market, and that fundamental is capital planning happens over a 10 to 15 year time horizon. And so when we sort of take that, when you always do that zoom out of any chart or graph where you've seen volatility in the public markets, or you've seen volatility in market movements, and you sort of take the 15-year perspective, you see that actually these massive peaks and troughs actually look relatively small when you take a step back. And so again, looking at capital planning over a 10 to 15-year time horizon, there are still immense amounts of capital, venture capital dollars and private equity dollars sitting on the sidelines that need to find a home. And so that liquidity will inevitably, that is being earmarked for technology and financial technology investing, will be invested in financial technology and technology companies. The nature of those investments is going to change, though. I think you're going to see fewer and fewer businesses that have very, very heavily stacked cap tables. So people, doing a series D, E, F, G, H, I, J, K, and all the letters of the alphabet. I think those days are behind us. I think you're going to see a far faster and a far bigger focus on the part of investors, post Series B, maybe Series C, and certainly before anybody gets to a Series E funding round, seeing the underlying profitability is there for these businesses and that they are resilient, strong businesses, as opposed to sort of punting profitability. And by profitability, I mean not break even, but very healthy margins being brought to the fore and accelerated.
And I suppose also, of course, let's not forget that there's still a lot of excitement about artificial intelligence and how this is going to, change everything and make everything better and more profitable and more wonderful. Is that something that's also, you talked about the time horizons of investors. I suppose they've also got this kind of excitement still that is happening around artificial intelligence to also perhaps encourage them to part with that cash for the longer term.
Yeah, look, I think it's a very, very good point. So artificial intelligence and leveraging LLMs, very impressive capabilities that you and I can interact with as retail consumers with your ChatGPT or your Claude or your Gemini. And it's not to be understated what these platforms are able to do. But the real value dollar unlock comes from vertical applications of these AI tools. That's a fact, because you need to leverage these tools to be able to increase in the first instance, increase efficiency in all businesses across the board, whether that's coding efficiency, market efficiency, customer service efficiency. And then you need to, so that's more of a defensive and an efficiency and a profitability play. But then invariably, AI then takes you into the front office and takes you into the revenue side of the equation, which is how do I create tools for my customers to use, which are 10 times more effective in terms of identifying issues, in terms of helping them solve their everyday problems. And how do I go from solving a problem that is $1 million problem for my client to being a problem that is a $10 million problem for my client, and then seeking to gain more of those economics? And so I think vertical applications in financial technology, I think financial technology is ripe for vertical applications. And I'm seeing AI being used across the board, across all of our clients, at least on the efficiency side, and now increasingly on the revenue generation side.
Okay, and of course, the other area that was generating a huge amount of excitement, certainly as in the lead up to Donald Trump taking office, was in crypto. Are we now in for another crypto winter as well? From since we've had the latest peak, are things now perhaps go away, come back in a couple of years?
Around crypto specifically?
Yeah.
I think the genie is out of the bottle on crypto. I do believe that there's no going back from where we are now. And the reason for that is severalfold. One is the fact that once institutional capital has been allocated and created, and it's found its way into pension fund plans, such as BlackRock ETFs and Vanguard wanting to do ETFs and a whole bunch of others. Once it's seen as something as a fundamental asset class that pension funds want to get exposure to, that is the ultimate validation that these are legitimate investments, that they are a legitimate component of any basket of investment products. I think once you've crossed that Rubicon, there is no turning back, and I think we've got to that point. Everything else, certainly in my mind, is then a question around how is it governed, how is it priced, and what level of liquidity does it soak up? So certainly over the last 6 months, this big crypto bull that we've had is a function of the fact that the market is just incredibly liquid. There's so much money on the sidelines, and it needed to go somewhere, and crypto was a very nice place to park it. So
Okay.
to the extent that there's still liquidity in a market, I think the crypto world is just going to go from strength to strength. You'll see more institutionalization, more regulation, and more applications and use cases.
Okay. Now you're based in London. I think you're talking to me from London right now,
That's right.
which is still the main hub in Europe for fintechs. I know we're obviously not in the European Union anymore. What can the newish government and perhaps the financial sector and the financial centre here do to kind of foster more innovation among fintechs?
So the obvious one that we all talk about is regulation, and I think the cost of doing business has continued to decline. I do think the regulatory environment that we operate in does need further refinement. Us being a regulated business ourselves, we see friction in a lot of the things that we do, and we sort of just wish that we had a regulator that maybe was a little bit closer to the action, and I think that probably goes to uh, uh, a better level of communication between financial technology businesses and the regulator. But I have to say, the FCA, when compared to anyone else in Europe, and certainly the rest of the world more generally, really is the gold standard in terms of how effective, how efficient, and how consultative they have been. So whilst I would hope for more, I look at the FCA, and I think it really is a standout organization in terms of what it's delivered for UK financial services and financial technology businesses. The other thing I would say, though, and I think this is the really big challenge that we face in Europe overall. So this isn't a sort of a UK specific thing, but it's certainly something where the UK can take the bull by the horns. Is an allocation towards venture and venture investing, and I think that comes down to the government's already in consultation around it to be able to loosen the rules around where pension funds and certain other liability-driven investing funds can park their money to be able to foster earlier stage technology businesses. It is a hidden tiger that we have in the UK that we are growing very effectively without actually having done a great deal to nurture it. I think if we were to nurture it more effectively, we would be a financial technology superpower.
Okay, let's unleash that tiger. All right, so look, Aman, it's time now for our round of rapid fire questions. Are you ready?
Yes.
Okay, great. So I'm going to put 90 seconds on my timer. Where is it? Here we go. And we're going to try and get through as many of these as we can. And just one word answers is all I'm looking for. And I'm going to start the clock now. Okay, so what fintech segment has the biggest potential over the next 5 years?
Crypto.
What is the biggest pain point in your everyday financial life that you'd like to see resolved?
Payments.
Are bank bosses ready for the AI revolution?
No.
Are customers ready?
No.
Do you think regulators in the EU and US have kept pace with all the new possibilities and behaviors in the financial industry?
No.
Have you personally ever invested in crypto?
Yes.
Are physical points of sales part of the future of finance?
Yes.
Are bank branches part of the future of finance?
No.
On a scale of 1 to 10, 10 the likeliest, 1 the least likely, how likely is it that over the next 10 years, one of the neobanks will be as profitable as a top-tier legacy bank? So out of 10.
10.
That central bank digital currency, CBDCs, will become a mainstream reality in America or the EU?
2.
That you'll be able to open a crypto account at a top-tier bank?
8.
That SWIFT will continue to be the main tool for transferring money around the world?
5.
That a new card or non-card-based rival will emerge to challenge Visa and MasterCard?
In Europe, 10.
And that we will see a top-tier bank or insurer bought by a fintech?
9.
Okay, we are out of time now. So for the rapid fire round and also for our conversation. So I just want to thank you, Royal Park Partners founder and managing partner, Aman Behzad, for joining me today. Thank you so much.
Thank you, Elliott.
Okay, and for everyone watching, we will be back again next time with another big name from the world of finance and technology. We do hope you'll be able to join us again then. In the meantime, don't forget to subscribe to the Paris Fintech Forum YouTube channel and to follow us on X at Paris Fin Forum. That's all for now. Hope to see you next time. Bye-bye.